Go ahead and get the content piece started. So Tom, if you want to give just a little bit more background, and we can go ahead and get started with the presentation. Thanks, Tom.
All right. Thank you so much. And thanks to everybody joining today for our lunch meeting here, I guess, for the Thai meeting. I thought it was going to be a nice, beautiful, sunny day, but it looks like it might rain here in Atlanta. But thank you all for attending today. Again, Tom's saying I've been actually at Merrill Lynch for 20 years, believe it or not. I celebrated my 20th anniversary in January of this year. And some of the things that I'm going to talk to you a little bit about isn't also just related to the stock market. I'm going to talk a little bit about the economic outlook, because I know as business owners or budding entrepreneurs, that's going to be really important to you as well. That's my niche as well, working a lot with corporate executives and business owners and advising them through times like this. One thing I will point out is, there's a lot of opinions out there as to what's going on in the economy and stock market and those sort of things. So what I'm going to share with you today is cultivated with our research department. And recently, actually for the last 7 years, we've been named the #1 research house on the planet by Institutional Investor magazine. And they do a essentially survey of research firms and analysts and whatnot globally. And so we won that award 6 out of the last 7 years, being the #1 research firm. So that's what I'm going to share with you today is essentially what's happened. I think we all know what's happened, where we are, put it in historical context from an economic and equity standpoint, talk about projections, what we're looking back towards in the future, hopefully dispel some myths that are out there. Again, everyone's got a lot of opinions out there, and there may be some misinformation as it pertains to COVID and economic data and things like that. And hopefully arm you with a couple ideas that you can take back and implement on your own. So I'm going to go ahead and share my desktop here.
Thanks, Tom. And everyone in the attendee room, if you guys have any questions, I know Tom is going to make this as interactive as possible. So as he goes through things, if you guys have any questions that you want to ask, it's very easy to do so. Just raise your hand. You should have a raise hand feature on your webinar. Just raise your hand. We'll bring you into the panelist room where you get to ask your questions live. And I'm going to be monitoring that and letting Tom know about who's raising their hands and then bring them on. So we do want to make this interacting. So do raise your hand if you want to ask your questions. We'll answer them live. If you want to also use the chat feature, you can ask your questions there as well. But we just want to make this as interactive as possible. So please do engage, and we'll be looking out for those, hands and also in the chat box. Over to you, Tom.
All right. Thank you so much. So let's start at the very beginning, right? Let's give a little background context to the crisis. So I think we all know, what's happened. The 11-year bull market ended in the last couple of weeks. It was the fastest time frame going from a bull market to a bear market. But really to focus on here is what to consider going forward. So one of the things that we always stress is you want to have a game plan when it comes to your investments as it ties into your personal life. You hear a lot about diversification. What's interesting is diversification doesn't work sometimes on the downside, but works on the upside. And we'll talk a little bit about that. And then we'll talk a little bit also about what you should consider as far as action steps to take. So let's go ahead and fast forward to this slide right here. There we go. So what happened here, as you can see, is equity markets have given up their gains over the past year and a half. And no surprise to anyone. But if you look at what's happened in the markets, if you were in the indexes last year, the indexes were up about 30%, anywhere between 28 and 31%, depending on, where you were invested in the markets. This is a global view of what's happened over that time frame. And you can see here, it shows you the returns year to date over the 6 months and the last 12 months. And believe it or not, if you were invested in the S&P 500, you probably are actually slightly ahead of where you were from January of last year. And I also want to point out here that this was the fastest drawdown in the history of equity markets, from going from the peak bull market to a bear market. And these are other points in history that show you the number of days going from the peak to a bear market over time. And this was extremely fast, extremely sharp to the downside. And it only took 21 days to go from a bull market that a lot of people were saying didn't have legs to it, and we were on the opposite side saying that it had a lot of legs to it, to going into a full bear market. With this slide here, I just want to show you that, you know, volatility spikes. You see a lot of volatility, ups and downs in the market, but typically what happens is in these times of unrest is you get a sharp decline in equity markets, but you typically get the strongest recoveries immediately afterwards. And so that's what I want to show you on the right-hand side. These are various times in the market and throughout history of things that happen. So you can see on the right-hand side, you can see 9/11, that crash. You can see the global financial crisis, the oil slick, but typically equity returns recover immediately after these spikes in volatility, and they typically recover in a strong way. And the other thing I want to show you here is that history shows that equities can recover even from some of the worst performances. And what I did here was layer on top the 1987 sell-off of Black Monday, which was the sharpest one-day sell-off, and today's sell-off, which occurred March 30th, which is where you saw the really big down day. What's really interesting when you look at this pattern is how eerily similar the trading pattern looks like from 1987. And you can see that the sharp down occurred on the May 30th sell-off. But if history is any indicator, and when there's a lack of data out there from a financial standpoint, from a number standpoint, traders wind up moving more towards charts and using things like this. So this kind of gives you a trajectory of what you could potentially anticipate over the next 100 days by May 30th from a return perspective on the market. So just to put that in historical context, not that past performance tells you a whole lot, but it sometimes rhymes, I guess, so to speak. And one thing that we get a lot of questions about is trying to time the market, when to sell, when to get back into the market, and things like that. And what this slide I wanted to point out was show you that, you know, if you got out of the market, what actually really hurt your return was not being in the market when the market rebounds. And what this shows you here, if you just missed the last 10 best days out of every decade, so this goes back to 1930 on this slide, if you missed the 10 best days of each decade, your return would be 91% versus 14,962%. So that's where trying to figure out where a bottom is and trying to sell and buy in really hurts investors, because you have to get two decisions exactly correct. When you decide to get out, you have to time exactly when to get out, and then you have to time exactly when to get back in. And so that becomes a really difficult value proposition by doing that. So let's move forward to page 11 here. And so what we're going to show you is the economic impact, the policy responses, what really got us here. And so everyone knows that about, you know, the market sell-off catalyst was COVID-19. You know, we don't need to rehash that. But what people may not know, it was that there was a double whammy that was happening, and that was oil prices. And that's what you're seeing the markets trade on today, is not so much economic data, but what's happening in the oil markets. And it's really odd because markets sold off. And if you think about the markets and economy, they are not one and the same. And you're going to hear this theme throughout, that markets typically go up and down before the economy follows behind it. So whether it goes up or down, economy is a lagging indicator where the market is trying to figure out what's going to happen 6 months from now. So end of March, first week of April, you saw that sharp sell-off in equity markets. And if you noticed, the unemployment reports that have been coming out have been really bad. You saw the first week, 6 million unemployed, 5 million unemployed. Yesterday, there was an announcement that there was 4 million people applying for jobless claims. To put that in context, during the financial crisis, the worst week of unemployment claims was 695,000. So that shows you how bad the economic numbers were coming out and how bad they are. But if you looked at that information and saw the behavior of the stock market yesterday, for example, stock markets were up when there was an announcement of 4 million unemployed. And what's happening is the market in March, the last week of March, essentially just sold off, priced in the worst case scenario because of the lack of data. And now it's starting to reprice based on the data coming in. So in this strange situation, in this strange market environment, you're starting to see that markets are shrugging off bad news and repricing based on the news of data coming in. So in this instance, bad news essentially can be good news because we just need data at this point. One thing you probably have heard about is oil in the news, oil plummeting. And what happened was, if you haven't heard, is Russia and Saudi Arabia were essentially fighting over oil. They were talking about cutting output, but what happened is the Russians didn't want to cut output because they felt that it would help the U.S. market. The U.S. is now the largest producer of oil in the world. And a lot of people don't know that the fracking industry and the shale industry in the United States in the last decade, the technology breakthroughs in that sector have been tremendous. And the cost of profitability for pumping oil has gone down. And that's where you saw oil drop, where essentially Saudi Arabia said, we are profitable with oil at a very low dollar amount, so we're actually going to increase our output of oil. So you've got that combined with the fact that people just aren't driving anywhere globally, and so global demand has shrunk, and that's where you're seeing oil prices drop. We think that this sector, the energy sector, is going to struggle for some time. We think other parts of the economy are going to rebound, but right now, for the next foreseeable future, 6, 9, 12 months, you're going to see the energy producers really struggle. And you're going to see the stronger players come out and buy the weaker players, whether it's bankruptcy or otherwise. And so the stronger are going to get stronger and the weaker will no longer exist. But when you look at Russia and Saudi Arabia and the rest of the world, they're clinging, particularly the Russians are clinging on to their number one economic output, which is oil, and trying to figure out how to make that work for their economy. So, and this just shows you the price movement of markets during various time frames and different oil shocks. So I'm going to move forward to the economic response. We're going to talk about policy, the impact, and what people aren't talking about. And again, if anyone has questions, feel free to raise your hand and ask. I would like to make this interactive, so I'm not just talking at people. Hopefully we can make this interactive. But this is our projections and our outlook for 2020. And this is compared to the consensus on Bloomberg. So Bloomberg does an amalgamation, an accumulation of various investment houses and does a consensus. And you can see that the estimates are for other places are actually pretty optimistic. And you can see from a global perspective, we think global output will be positive. But if anything, we're probably a little bit more bearish on the United States and the economic output. So again, to separate the economy from the stock market, we think the U.S. will be in this recession for the next 12 months to a year and a half till it gets back to where it was in February. The stock market, on the other hand, we think will rebound. We think that the trading pattern in the stock market will look more like a square root symbol, where you had the bottom, we hit the bottom, bounced off of it. You'll be a pretty choppy trading, and that will be flatlined for a little bit of time. But this is our growth projections in various areas. You can see that China, people are being very optimistic on China. We don't think China is going to be growing as much as other folks believe they will be. One thing you're seeing is unprecedented global monetary and fiscal response. So wanted to put in context what countries are doing, the output that they're doing, and the measures that they're taking in order to stem off a global depression. And this shows you all the different countries and what their actions are. So you're going to see a rapid response and a rapid push in the economy around the globe to prop up their economies. So let's look back here at the United States, and there's really been three responses from a health, monetary, and fiscal response. So the first wave, you saw about $8.3 billion package from a healthcare perspective, from FEMA to help state and local governments towards containment. You saw the monetary response where you've seen interest rates drop on the Fed funds rate to zero, which is very positive, very stimulative to the economy. And if you haven't seen, the Fed is now entering into a quantitative easing program, which is what they did coming out of 2010. The most important thing on the far right-hand side, it says, what else, is the stimulus package. I know if there's business owners on the call, I've spent the last couple of weeks just trying to get clients into the PPP program, that funding. Right now, what we're seeing internally is that there's going to be a small percentage of companies funded in the PPP program right now. There'll be about $600 billion that's going to be approved through Congress. We think that $1 trillion is the range that they really need to increase this to through various structures here. So if you look at the output of the United States, what we think is going to happen, if you look at the GDP output of all goods and services right now, is the GDP of the United States on a regular year is about $25 trillion. We think when this is all said and done, you're going to see a total package between $6 and $8 trillion of money coming into the system. That is unprecedented and will fill a huge hole. And what's not being talked about is the timing of this whole COVID situation. If we can get our arms around this and get the country back to work when it's safe and ready to roll, and you've got $6 to $8 trillion of stimulus money sloshing around, what we think is 2020 is going to be a rough year economically. We think the stock market will be volatile, but will still end the year higher. But we think this sets up for 2021 to be a very robust rebound. It's not really popular to talk about, but we think that if you have a quick response, relatively quick response economically, that 2021 can be a very strong recovery year in the economy. And I pulled this slide up just to show everyone what happened with the Fed funds rate here. You saw the Fed funds rate get cut in March 3rd, where they cut 150 basis points essentially down to zero. One thing I also want to mention is—
Hey, Tom, you had
yeah.
sorry, I didn't mean to, you had a question from Parthik.
Okay.
I don't know if you see it there in the chat box.
I do not. Sorry,
Okay.
I only have—
What will be the inflationary pressure with that 6 to 8 T of money injected into the system?
Yes. So we don't think it's going to be inflationary because that is filling a hole. Now, it kind of gets back to what I just said, that if it plugs more than a hole, so let's say the hole in the economy is $4 trillion, there's $8 trillion that go in, we think that you will see some inflationary pressures at that point. Right now, what we think it's doing is plugging the hole, and that's what we're trying to determine right now is how big is that hole as numbers start coming out, economic data comes out. But the longer we keep the country shut down, the worse this becomes, obviously, from an economic standpoint. Statistics show that if we can get the economy getting back up and running sometime in May, the economy comes back and only loses 4% of its productivity. So, Karthik, to answer your question, in that situation, yes, you would see an inflationary pressure. But what happens if we don't get back until end of June, July timeframe? The percentage of output that gets recovered goes from 96% down to 80%. You're talking a huge drop in output at that point, and that becomes more of plugging a hole versus being accretive. So at this point, we're still a little bit in a wait and see mode as it pertains to whether it will be inflationary or not.
We have one more from Vignesh. I'm actually bringing him on. He actually raised his hand, so I'm bringing him on.
Okay.
And I got two more questions after that.
Yeah.
Okay, while Vignesh comes on,
Yeah.
the question Kanchana had, actually Vignesh, you're on to ask your question. Unmute him. Vignesh, I have you on to ask your question. Go ahead.
Yeah, so there's a $2.2 trillion dollar that is getting inflected into the economy. What are the impacts of that? Will we see increase in price? Or what do you think will happen to the short term and long term price influxes within the economy?
Yes. So if you take out food and energy, we think right now that you're not going to see an inflationary pressure because of what I was just mentioning, that right now we're trying to plug a hole from an output perspective. The difference becomes, like I had just mentioned, that is if we keep the economy closed until July or longer, that's when it's going to be something where it can be, it won't be inflationary. But if we get back to productivity sooner than later, then it will be inflationary. So that's where the jury's still out on how this is going to affect us from an inflationary standpoint. But one thing I will mention is going back to 2008. If you think about the last decade in what happened, right? What was the mantra going in the last decade? Is the government's printing money, we're going to have rampant inflation, and that prices are going to go through the roof. And none of that came true, and it's still not true. As a matter of fact, what happened is let's back up a little bit before February. We were in a zone where we weren't worried as much about inflation. We were actually a little bit worried about deflation, which is why you saw the Fed take some of the actions it did in 19 of cutting interest rates and things like that. It was a response to 2018 when they increased interest rates too fast, too soon. So the jury's still out, but if we can get back to productivity sooner than later, 2021 could be an inflationary situation and a really gangbuster time in the economy.
We had one from Kanchana. 2021, is that a rebound for US or globally?
For both. But we think the US will come out of this much stronger. So if you think about, let's take Europe, for example. We have, let's compare us to Europe. So we have a very strong Federal Reserve System, very strong treasury. If you think about the Eurozone, it's not unified at all. You've got all these countries with different central banks, but one common currency, and they have to agree on policy. And that is the biggest difference between Europe and the United States, and why we think that the U.S. is going to way out perform globally for the next couple of years right now. China's in a situation where they can, I don't trust all the data coming out of China, but we think China is something that can rebound also because they can just pump up their economy as needed. But we are more US centric right now than internationally, because also what's going to happen is even before this whole thing was happening, you were starting to see supply chains recalibrate from the tariffs in China. And for those of you that had manufacturing facilities in China, I can tell you I deal with clients who have those set up in the manufacturing plants in China. They're actively, and they were already looking to reconfigure their supply chain. I can tell you that's been fast-tracked. What we're realizing is we cannot rely on China from like we have in the past. I'll show you some statistics here of the things that we do rely. So for example, Apple manufactures only 10% of their products, of their supply chain here in the United States. There's so many countries like that, or companies like that. So we think this is the decade where we start moving back more towards the United States. And I'll also show you a slide that there's a theme for the next decade where we think it's going to be protectionism across the globe. So I'll get into that a little bit, Kanchana, but hopefully that answers a little bit of your question.
We got a couple more. You want me to go ahead and ask them, Tom?
Yeah, go ahead.
Okay. So Tim Older had a question. What is the impact of state and local aid on this? Seems like New York, New Jersey, California will need significant aid.
That's right. So one of the things that the federal government, that's part of the stimulus package, right, is they're going to backstop this. They're going to put the money into the system. If does anyone recall, and how you doing, Tim? Does anyone remember the name Neil Kashkari? So if you heard the name Neil Kashkari, it should ring a bell to you. So Neil was, he was with the Treasury Department back in 2008, and he was part of the team that developed TARP, that came up with that whole concept of the TARP system. He's now a Federal Reserve president out of Minneapolis right now. And he is working on this with the Treasury. And he's also working on this package along with Chairman Powell of the Federal Reserve. And one of the things that he has come out and said is they learned from 2008 and the mistakes. They have a playbook. In 2008, they didn't have a playbook. And what them and Mnuchin have come together and talked about is there is no cap. So there is no cap to the amount of money that they will spend to make sure that we don't go into a massive depression. Kashkari and his team, they know how to handle this. And so they're going to get states are going to get aid from the federal government is what is going to wind up happening in this situation.
All right, got one more from Robert. GDP equals private consumption plus gross investment plus government investment plus government spending plus imports, exports minus imports. If government investment and government spending is so high, why is GDP falling? Is there really a 8 trillion plus fall off in private consumption and gross investment?
Well, that's what we're trying to determine right now. But what it is it's the consumer. Consumer is 70% of GDP output. And if you look at the economic data from that, it's been pretty bad. One thing we have that's really cool at Bank of America Merrill Lynch is when we do research, we have visibility into credit card spending behaviors. And what we noticed in the most recent report that came out a couple of days ago is consumer spending was down about 30% for the month. What we noticed is we also tracked the stimulus checks that came in, and we also tracked what products and services that they spent money on. And it was really interesting to see that that money was spent. So if anyone's wondering if the stimulus is working from the stimulus checks, it is. Actually, most of that money was spent on groceries and, believe it or not, electronics and online shopping. But most of it was groceries. But that's where we think the hole is on the U.S. consumer.
Continue, Tom.
Okay. All right. So let me get back on track. That was good questions, by the way. Thank you all for those. That was fantastic. So I'm going to move forward, talk specifically about equity markets, fixed income. I'm not going to spend a ton of time on this, but this will put things into perspective, hopefully. But the biggest thing is for equity investors is if you lengthen your time horizon as far as thinking about returns. I think this is pretty straightforward, but I always want to reiterate this to people, is that this shows you the range of probability of negative returns by time horizon. And you can see that, within a day, you've got a large dispersion of return, but look what happens when you get out into 5 years and 10 years. The chances of you losing money is only 10% over a 5-year period. And that's if you just move 5 years along the spectrum, or said another way, 90% of the time you make money over a 5-year period. So that's really, really important to keep in mind when you look at this, because I know we're all just looking at 2020 and worried about it. The other thing to look at is, and you're going to hear this theme, is we're actually negative on fixed income and bonds. And you say, well, Tom, that's crazy. Why would you be negative on bonds in this time, right? Wouldn't you want a ballast in your portfolio? You'll see, I'll dive a little bit into fixed income, but right now, dividend yields on stocks are higher than what you get on bonds. And this shows you basically dividend yield compared to the treasury bond. So right now you can buy Microsoft, getting a 2% dividend, where right now the 10-year treasury, if you tie your money up with the government, right now I'm looking at my screen, basically you'll get paid 0.67% to tie your money up with the US government for 10 years. So it just doesn't make a lot of sense. One thing I'll also mention for investors to do right now, not investors, just people right now, if you haven't done so already, and maybe you did this in the last year, is look at refinancing your home. Interest rates have dropped tremendously in the last year. They haven't dropped as much as you might think because mortgage rates aren't directly correlated to what the Federal Reserve does. And that's a really big misconception, but it's worth taking a look at.
Tom, we got one more question
Yep.
in relation back to GDP. So this is
Yep.
from how can GDP get restored to pre-COVID-19 levels after the crisis is over? Some fundamental changes in the industry will continue, such as increased teleworking, less travel, airline, cruise industry, long-term impacts, etc.
That's right. So we think that there's also pent-up demand that we think will happen. We're starting to see it right now where companies are starting to talk about coming on up online, and we're seeing things already getting lined up. So I'll give you a good example. Like, there's a big debate on hairdressers. I mean, this is a small part of the economy, but we're seeing, like that sector. I can't tell you how many people we've been talking to that they already got appointments lined up for this coming weekend and things like that. So we think there's going to be a lot of pent up demand for goods and services. We just don't know exactly what it will look like. But like I said, if we can get over this COVID situation and get back to our normal social distancing situation and get back to spending, we think this can be a robust 2021, but the jury's still out on that. The other thing that I'll mention on this end is if you have a couple of states open up, and we're starting to see that right now. So for example, obviously you've heard about Georgia, but we think a lot of states are going to begin to open up in the next 2 weeks, which is much more bullish than the models have suggested, which is why you're also seeing markets shrug off bad economic data because it's forward looking. Japan was revered for their initial response to the pandemic. They're more hygienic culture and things like that, but they've been a pretty good window into economic output and things like that, and they've been coming up back online here. So that's what we're thinking right now. Also, the dynamic. Let's say 2 states open up. States are going to be in competition with each other. So, for example, let's say Oklahoma opens up. I'm just using a random state, or Alaska. If you can get goods and services, within your supply chain, you need to acquire those, and you can get them from Oklahoma. Guess who's going to come out on the top end of that situation? And so that's going to force other states to be in competition to get back to work. And whether it's right or wrong, that we just think that's the dynamic that we see. Any other questions?
Nope, you're good. You can continue. Thanks, Tom.
Okay. So based on what's happened with the markets from an equity standpoint, you can see here that equities have become really attractive compared to bonds right now. And this is something that I will tell all people that you can go back and use is when the dividend yield on the S&P 500, so all 500 stocks, you take the dividend yield on that, is greater than the dividends from the 10-year treasury. Markets have been up 94% of the time. And the average is by about 20 percentage points on average. And this shows you the S&P 500 dividend yield compared to treasuries over the history. And look at the current level right now. And this is a raging bullish sign. If you're looking to invest, I'd be looking 12, 24, 36 months out then what's going to happen in the next 6 months, because you're going to see this volatility. But right now, this is a screaming buy signal that you don't get very often. And, trying to also look at some various sectors to look at if you're in these different areas with your company. These are the areas that we think are going to be major themes influenced by COVID. Like you were saying, digital media, entertainment, cloud computing, robotics and automation, online retailing. So we think a lot of these will be winners. And so if you're in this area, this is where you think that you'd want to be spending your time. And as you grow your own business, these are areas to think about. So I'm going to switch to a different deck real quick. Hopefully I can find my...
And attendees, if you guys want to ask your questions live, just raise your hand, or you can type them in if they're quick. And Tom, actually, while we wait, we got another question.
Yep.
This is from Vignesh. While the states are competing, economy may get back, healthy competition, etc., but the risk of lives may be put put backwards. The risk of the virus and health may be pushed back. Is there an economic figures, ground risk versus reward? If yes, can we read more about it?
Yes, and so you're talking about the second wave, I think, is what you're referring to. And yes, that risk is there. And that's why, from an economic perspective, our outlook on the economy is probably a little bit more bearish in the short term, of a negative 0.8% GDP output for this year. So when you look at it from an economic standpoint, you're right. There's a big debate on that, and I don't think anybody really knows. I think what's happening is you're seeing governors and the government take a look at pure statistics. A couple things that aren't being talked about is there's been, as a couple days ago, there were 42,000 deaths from COVID-19. 50% of those deaths were in New York and one part of New Jersey. So that's one piece of information. The other piece of information, if you've heard these studies coming out of Santa Clara and whatnot, the theory is that there's a lot more people that have been infected by coronavirus that did not have symptoms. And so the mortality, when you add those figures in, the mortality rate for people with COVID is actually more in line with the flu. And I'm not saying that I agree with that or not, but that's the debate that's being had right now, is that, and the economic impact for sure.
You got one more from Tony.
Yep.
And again, everyone, we will be sharing the presentation and Tom's information, post this via email to all that attended. So you guys can definitely, schedule time with him. But Tony wanted to hear if you could elaborate more on the equity buying signal. Yeah.
So on the equity buying signal, basically, if you look at the dividend yield on the S&P 500, it's about in the 2.5–3% range. There's only a certain amount of time in history where that dividend yield has been higher than essentially the 10-year treasury. To put that in context, the 10-year treasury, and why is that 10-year treasury so important? And I would say if there's one takeaway that you can learn about bond markets in this talk, is the 10-year treasury interest rate. That's the interest rate that globally investors use and compare their instruments. So if they own a bond or have a stock or anything, they say, what's the yield I'm getting compared to that 10-year treasury? The historical yield on the 10-year treasury is about 5.5–6%. Okay, throughout the history of that interest rate. So for example, and also mortgage rates are sometimes based off of that rate, right? They're a little bit more in line with the 10-year treasury. So if you look back to in the 80s, if anyone owned a home here in the 1980s, your interest rate on your mortgage was probably in the mid-teens because the 10-year treasury was at 14%. And so there's only been a few times in history where the dividend yield of the S&P 500 is higher than the yield on the 10-year treasury. And when that has happened, the market has been up 94% of the time, and the average return has been 20%. There's another indicator. I don't have the chart on me here, but I can send it out to people, is we do a survey at Merrill. It's called the Bull and Bear Indicator. And we interview fund managers. It's called the Fund Manager Survey. FMS is the acronym. And money managers opt in globally into this Fund Manager Survey. And what we do is we have an indicator from 0 to 10. 0 being, are the money managers super bearish, and 10 being super bullish. Okay. We use this as a contrarian indicator. And what I mean by that is if everyone's super bullish, then the number would be a 10 on this rating. And we would use that as a sell signal. Right now, this indicator has not read as low as it's been since 2008. It's at a 0 right now. And same thing with the indicator I mentioned previously. That indicator is correct 90% of the time, and the average return is in double digits in our bull and bear indicator. So right now it's a screening buy signal as well. I'll throw that out there also.
Thanks, Tom. I think we're getting into the last 5–10 minutes here because we want to be mindful of everyone's time. And then what we'll do is 5–10 minutes of content left, and then we'll still open it up for Q&A for the last 10 minutes. Go ahead.
Okay. All right. So I'm going to fly through this then. So one thing to take away, this is our asset class views of where to overweight. And you can see green is obviously good, red is bad. And you can see even with the market volatility, I mean, we're bullish on US equities. You can see we've recently downgraded our outlook for emerging markets. And we also downgraded US mortgage-backed securities in the bond area. But you can see in general, we are very bearish on bonds because the prices of bonds are so high and you're not getting much return for that. So let me fast forward to page 20. So I'm going to try to skip a few. One thing just to put volatility.
You have a question, Tom, sorry.
Oh, yep.
So Curtis asked, is your S&P yield based on current dividends? Aren't the dividends predicted to fall in 2020 for the S&P?
It's on current dividends, correct, but that's if that's depending on if if companies cut their dividend. And here's the thing: why companies won't cut their dividend. If you're a company that issues a dividend and you cut that dividend, your stock is toast. And I know companies and some companies will do it, but your stock is going to plummet if you cut the dividend. So we don't think there's going to be as many dividend cuts as people think right now. If anything, we think that will be a way for money to be returned to shareholders because you're not going to see stock buybacks as a way to return shareholder value. And that's where a lot of money's been deployed over the last couple of years. You've heard it on the news, but you're going to see companies keep their dividend intact. And the days of buying back your stock, we think the next decade that's dead. We don't think that's coming back.
Go ahead, Tom.
Yep. So I'm going to fly through these last couple of slides. I just want to show you here. A lot of people say, oh, we haven't had corrections. They've been so bad. I just want to point out in the 2010s that we've had 6 corrections in the 2010s because everyone says, oh, the market can't go much higher, et cetera, et cetera. But look how many highs we made in the last decade. We made 242 highs during this decade, but that still is less than what we made in the 90s from new highs. And the number of corrections we had, people don't forget that we had corrections in the 2000s. And you can see the average return still wasn't as high in the 2010s as other decades. So I would just want to point that out, put in context. So I'm going to go to page 35. And I just wanted to, Kanchana had made a good point here, but these were just some interesting facts that 95% of these products here, we rely on China. So that was something that I wanted to point out to you, was that particularly, because it's a pretty staggering statistic as it pertains to that. And then let me go to my last 2 pages here.
And everyone, this recording will be shared via email as part of the follow-up. So if anyone that joined a little bit late and misses some of the beginning, you guys will get this recording. Go ahead, Tom.
So I thought this was really appropriate for this group here. Is the one thing in a place that we play a lot in is in private equity. We think this is a great opportunity right now because private equity funds are sitting on dry capital. They got to put it to work. So it's a great opportunity for them to buy private companies at very attractive rates of returns, and also for sellers, right? It's a great way to partner up with other firms, whether it's a platform sale or an acquisition. It's a really good time right now in the private markets to make money. So I'm going to transition one last thing here. I'm going to leave you with. Is there a question there?
Yeah. You have one question. So what are your thoughts on investment in gold?
You stole my thunder. I was about to mention gold. That was one of the themes I was going to end on. Is we have just put a price target of 1,300 on gold. And part of that is, I want to leave this teaser for you, is there's some really groundbreaking research that our firm is doing on thematic investing. And I talked to Amin about doing another workshop just on this. We call it a transforming world. And we pick various mega trends that we think will happen, not just in the equity market, just the global demographics in general of what we think is going to happen for the next 10 years. And so these are some of our themes. And what I was mentioning is peak globalization. We think this is the end of unrestricted movement of goods and labor. We think there's going to be a retrenchment across the globe. Demographics. The number of grandparents you can see will outnumber the world's children, in the next decade. Climate change, you always hear about that, but we think that companies are going to be really laser focused on this, and large companies on change. Automation, this is one that really scares me, is that 50% of jobs are at risk of automation by 2035. Splinternet, this is a really big topic, and why we think that the retrenchment to going back to domestic and focusing on domestic companies is right now China is trying to overtake the US and become the world leader in AI in the next 10 years. For the first time in our history, China is outspending the United States in research and development. This has never happened in the history of the United States, and one of the reasons why the United States has such a distinct advantage in the globe is we spend a lot of money privately on R&D, and China will take us over in R&D spending this year. ESG, if you hear about this isn't, that stands for environmental, social impact investing. I would say that's not just a way to invest. This is a way CEOs are going to govern their companies going forward. And there's statistics that show that companies that really put forward environmental, social causes outperform in the S&P 500 as well. Smart everything, and then space, tourism, you're going to see that be something here. And so this is the chart I wanted to leave you with, is the new paradigms of the 2020s investment themes and economic themes compared to the last decade. And you can see it's almost an exact opposite. One thing I thought was interesting is we went from Occupy Wall Street, that whole theme and strategy, to Occupy Silicon Valley. You're seeing it with Facebook and the concept of universal basic income, high taxes, clean energy. So that's what I wanted to leave you with, was this chart of something to think about as you work in your businesses.
Thanks, Tom. Again, really appreciate you taking the time breaking all this down. So now what we'll do is we'll kind of leave it open for Q&A. So if anyone wants to either come online, raise their hand, we'll bring you into the panelist room to ask your questions. And we do have one question, as anyone wants to, if anyone has any questions. The part of the cat asked, so gold is trading at 1,700. Are you saying it's going to drop by 20%?
I'm sorry, I must have misspoke. I must have given the wrong number. I meant, let me go back to, I'm sorry. We meant to say that gold could get to 3,000. I totally misspoke on that.
Yeah, he had said 13. He said you had said 1,300. I guess.
I'm sorry. I was looking at the wrong data point.
Thanks for paying attention. I know that everyone's looking at the information. So thanks, Parthik.
Sorry. Yes.
And we have one other. So I'm going to bring Juan into the panelist room. He has a question.
Okay.
All right, Juan, you should be on. I'm going to unmute you. I think you might be muting. Try to mute yourself, Juan. Yeah, there you go.
Let's see. Can you hear me now?
Juan. Yeah. Hey, Juan. How are you?
Hey, just, one of the things I want to catch your idea, right?
Yeah.
I've been hearing a lot on these economic parameters and this shift that we're doing, right? So we've proven the last month or so that pretty much the economy, or well, the entire country can still semi-work or keep functioning, right, with everybody at home.
Mm-hmm.
Did you see any trends going to kind of like the workforce now being, kind of like in the Uber model where, you're pretty much just up for hire and the company's just, hey, I needed 10,000 of these and 5,000 of those, and you just sign up. Do you think that's where we're going?
Yeah, we think this situation didn't change anything. What it did, it's accelerating change. So we think these changes were in the works. I'll use my company for example. If you think about your old stodgy bank investment firms, right? You think of big offices and things like that. What we're doing, we're moving our office to another location, and we're keeping the same amount of people, but we're shrinking the footprint by 15,000 square feet. And now what we're talking about now is we've settled into our work from home posture. And, the CEO of our company is saying, wait a minute, we're onto something here. Maybe we don't need to go back even when it all opens up. We could probably do this with a lot less of a footprint. So that's where we think, real estate, we think real estate can really be affected by this. And we think this is going to accelerate change across the globe. If anyone watched the NFL draft last night, I don't know about you, but that was very different. But I can tell you what, they said it was a lot faster, more efficient, and they can drive a little bit more, ad spending as well. To people were wanting to see, these people in their living rooms and things like that. So you're right. This is going to be disruptive long term. It's not anything new. What it is, it's speeding up the adoption of technology.
Thanks, Tom. Juan, did you have anything to follow up with? If not, you can go ahead.
No, thanks. Thanks, guys. That was
Thanks,
it.
Juan.
Thank you.
We had one question from our good old friend Dinesh, which is, what's your take on the banking segment? Will it recover fast?
So, from an equity standpoint, that's actually one of the areas we like because banks pay a dividend. We think they're really well capitalized. That's the other thing I did not mention is banks, because of the stress testing they have to do, is they can withstand a drop in GDP by like 50% and 25% unemployment, those types of numbers. And so if you notice, banks, I know our company, I'll speak for, Morgan Stanley, other companies, that they've come out and said that they will not fire anyone in this cycle. And banks are notorious for when the cycle goes bad, they lay a lot of people off, and they've said they're not going to lay anyone off. Think of banks as a reflection of the economy. That's really all they are. They're a leveraged reflection of the economy. Community banks and things like that are a reflection of their local communities. So if we think that 24 months from now, the economy will be back up and running, then yes, we think banks will do well. And a couple areas that we like is our financials, technology, large company technology, because believe it or not, that's the one sector that is the healthiest right now because they have more cash and the least amount of debt on the books, is technology. And that's why you're seeing, the NASDAQ, for example, I'm looking at it year to date, it's only down 4%. It's down 4% for the year. The S&P 500 is down 13%. And what's interesting is the Dow is down 17%. So you're seeing, a bit of a changing of the guard too. That's what happens a lot of times in these volatile times.
Got one more. Rahul had asked, how long do you think it'll be before the RETIs recover? Also, do you feel many will have to hold dividends for a while before recovering?
I'm sorry, can you repeat that again? I missed that last part.
How long do you think it will be before the RETIs recover? Also, do you feel many more will hold dividends for a while before recovering?
Wow. So REITs, real estate, REITs are down 35%. I think that was their maximum drop. They've gotten hit pretty hard and they're levered. We don't see real estate rebounding right now. I think we're just getting into the beginning innings of how real estate's going to be treated. And it also depends on the type of REIT, right? Hotels, they're going to struggle. If you're in industrials have kept their value. One thing that we're able to invest in is everyone's probably heard of Blackstone. So we're able to invest with Blackstone into their real estate portfolio. It's private real estate, and 80% of their portfolio, of their $32 billion in real estate portfolio, is in industrial and multifamily housing. And I asked the head of their fund whether they would miss if they missed any payments or anything. They said that their companies have paid them. So public REITs are a little bit more difficult to project, but it depends on the area they're in. Hotels will struggle. Multifamily, we think will be okay, and industrial, we think will be okay. But if you're in the hotel space, it's going to struggle.
Thanks, Tom. Paula had asked, with people not paying rent, do you forecast what do you forecast will happen with the CMBS market?
So CMBS right now, yeah, we've been staying away from that. If you noticed on the slides we had before, we actually downgraded that area. So we're pretty negative on that CMBS space right now. Capital markets, if you're looking, I know there may be some real estate investors, people looking to buy hotels and things like that, maybe refinance in the conduit market using CMBS. Those markets have dried up right now. So there's not any new capital being deployed in that space. But yeah, that's tough right now.
Thanks, Tom. All right, anybody else? If you guys want to come on, you can raise your hand. We'll bring you on to the panelists to ask your question live. Any other questions? Go ahead and ask now. Going once, going twice. All right, Tom, do you want to close with any parting thoughts?
No, I would say I'm gonna stop my screen broadcast and come back to front.
I think everyone would love to see you as well.
All right, let's see. The back here?
Yep.
Oops, did I start barking? Anyway, so with that, what I would say is a couple parting words I would say is recommendations are have a game plan, right? Meaning, and have a way to stress test your portfolio, make sure it fits in and aligns to what you're trying to do. Also, the other thing I would do is rebalance. This is a great time to take some profits of some things that have gone up and buy things that have been beat up right now. If anybody would like research, I put out our latest research probably once a week, every couple of weeks on that. If you'd like to let us know, we can put you on our mailing list and send you out some of this research, and particularly the thematic research is really dynamic. So thank you all for attending today.
Tom, thank you very much. Again, everyone that attended, great questions, great engagement. Love that you guys found this of value. As mentioned, what we'll do is we're going to share this recording with you. We'll have Tom or myself either send an email to everybody with some of the stuff that Tom shared. I'll probably ask him to consolidate a little bit of it and send it over. But we'll share Tom's contact information. And as Tom mentioned, I think it's I'm on that mailing list. So I love getting the updates from Tom, which is great. But everyone, thank you guys so much. We'll go ahead and end the meeting now, and we'll be following up via email. Looks like we had one last question come in, Tom.
Yep.
And if anyone has to jump off, it's no problem. This is being recorded. So Tom asked, another Tom, given the oil and gas challenges and excessive reserves in the market, what does your company see as long-term for this sector?
As far as like the price of oil or just the sector in general. So if you look at the energy sector, we think the big player, there's going to be bankruptcies, right? So you're going to have the big players come in, buy out the smaller players. The thing about the energy sector that no one talks about is with the evolution of technology, it's not like rigs go out of business. What companies do now is they just turn off the spigot, right? It's really tech enabled now. It's really amazing what these frackers and shale companies have done. So in the short term, obviously, we think it's going to be negative. But the other headwind is we think this is going to accelerate the movement away from fossil fuels. We think this is going to accelerate, that technology for EV vehicles and things like that over time. People are looking at different things right now. So right now, demand is pretty low. But we think it's going to come back. But we think this will fast forward the move more towards sustainable energy sources.
All right. Thanks, Tom. All right. So we're going to go ahead and wrap it up and end the meeting. We'll be following via email with the recording to everyone that attended so that you guys can obviously at your leisure digest this once again. And if you guys have any questions, we'll also be giving Tom's email as well. But Tom, appreciate your support. Thanks, man. Again, attendees, thanks for attending. And we'll be back online doing another session, hopefully in the coming months or probably in the coming month with Tom again. But again, appreciate you guys. Have a great weekend. Thanks, Tom. Thanks, guys.
Thanks, everybody.
Bye.